Welcome to the deep dive.
Yeah.
You're here because you want to get smart about stock investing and do it efficiently, right?
Yeah.
Without feeling like you're just drowning in data.
Exactly.
Our mission today is really to give you exactly that. The key insights, those, aha moments that can really help demystify the market a bit.
That's definitely the plan. And for this deep dive, we're pulling from a fantastic resource, the book One Up on Wall Street.
Oh, yeah. Good one.
We'll be pulling out key ideas, strategies from across the book, really drawing on the author's deep experience. He was a very successful fund manager.
Right.
So think of this as maybe your express lane to understanding some really effective ways to approach investing.
Exactly. We're not just summarizing, are we? We're like digging out the actionable stuff, those surprising little nuggets that can shift how you think about picking stocks, building a solid strategy.
Right.
And we're going to try and do it in a way that's, clear, engaging, and leaves all that heavy financial jargon at the door. Okay, so let's dive into our first big idea. This surprisingly powerful advantage that everyday investors might have, what the author calls the edge of dumb money. Sounds a bit harsh, but...
It does, but it's actually quite positive. What's fascinating here is this whole idea that your experiences, just as a consumer, someone, moving through the world, can actually give you a real leg up on the Wall Street pros.
A leg up? How so?
Well, you see things happening, like on the ground floor, often way before the big analysts even catch on.
It's a really empowering thought, isn't it? The book gives some terrific examples, like think about the early days of Dell computers.
Right.
You didn't need a finance degree to see they were getting incredibly popular, did you?
Nope. They were everywhere.
Or the rapid expansion of Home Depot. I mean, those stores were popping up all over the place, always seemed packed.
That's real world observation.
So the core here is that your daily life, it isn't just, buying stuff. It's like a live action research lab for potential investments.
Exactly. You're seeing trends unfold before the analysts even get the quarterly numbers crunched. Precisely. The author also mentions Harley-Davidson, you might have noticed, maybe professionals like doctors, lawyers getting into the whole weekend biker thing.
Yeah, I remember that phase.
That wasn't just some fleeting fad. It really signaled a real growth in the brand's appeal, a wider audience.
Okay.
And think about a company like Paychex. Kind of behind the scenes, right? But quietly solving this massive headache for tons of small businesses by doing their payroll.
Yeah. Necessary stuff.
These are all things you could observe right there in the real world.
And it's not just these huge, obvious shifts either. The author even gives credit to his wife, Carolyn, for spotting winners like Legs Pantyhose and Pier 1 Imports.
Just by noticing what was popular?
Yeah, just noticing what people were actually buying. It really drives home the point that our own lives are like a constant stream of potential investment ideas.
Which raises a good point, right? How often do we just ignore these everyday observations, thinking they're too, small time for the world of finance?
Yeah, like what do I know?
The book really encourages you to invest in what you know. Maybe you're a regular at Dunkin' Donuts and see the lines out the door every morning, or you shop at the Gap and notice, things seem to be selling well consistently. These personal insights can give you a really significant head start compared to analysts who might only pick up on these trends in quarterly reports way after the stock has already started moving.
That's such a key takeaway. You're seeing the story happen in real time, not just reading the summary later.
Right.
But the book also throws in a crucial reality check. There's the example of Billner's. This business the author went to a lot, liked it, but the stock was a loser.
So just liking the place isn't enough.
Exactly. It's a great reminder that just being a loyal customer doesn't automatically mean it's a good investment. You still need to, look under the hood at the actual business fundamentals.
That's a really critical nuance, isn't it? Just because you love their coffee doesn't mean the company is well-managed or financially sound.
Right. Got to do the homework.
It highlights the need to go beyond just, oh, I like this product, and do some actual research. Okay, let's shift gears a bit now. Let's talk about a really crucial stage. Preparing yourself, getting your own head right for investing.
Mindset.
Yeah, mindset, and adopting that long-term view.
Absolutely. The author really stresses that before you even think about buying a single share, you need to make some fundamental decisions first.
Such as?
What's your basic feeling about the market overall? Do you generally trust that, corporations can grow and innovate over time?
Okay.
basic beliefs.
What are your actual goals? Are you trying to make a quick buck, or are you really in it for the long haul, building wealth slowly?
Right, short-term versus long-term.
And this is crucial. How do you think you'll react when the market inevitably takes a dive? Because it will. Yeah, anticipating your own reaction. That's interesting. The emphasis is really on your preparation as an investor.
Mm,
It's not just about picking the hot stock or trying to perfectly time the market, is it?
right.
Your own mindset, how you handle the ups and downs, that's absolutely paramount. Like the book says, if you don't have conviction, if you tend to panic and sell when things drop,
You become a market victim.
exactly, you end up selling low.
The author shares a really relatable story, actually, about being too pessimistic early in his career, always thinking the sky was falling.
A common trap.
Yeah, totally. And he also talks about an early investment in Flying Tiger Airlines. He bought it based on a sort of flawed idea about the air freight business.
Ah, so even with research.
Even with some research, yeah. You could still get it wrong if your basic assumptions aren't quite right.
And this is where that long-term perspective really becomes important. The book mentions successful contrarian investors like Max Hine and John Neff.
Contrarian.
It's so
People who go against the crowd.
Precisely. They built amazing track records by buying stocks that were, out of favor, unpopular.
Okay.
They were willing to look weird for a while, basically, and have the patience to wait for their investments to eventually pay off.
It's also really interesting why the big players, the institutional investors, might initially ignore smaller, less-known companies.
Why is that?
The author calls it career risk. If a fund manager bets big on a small, unknown company and it goes wrong.
It looks bad on them personally.
Exactly.
Hmm.
More so than if a big, widely held stock underperforms. So this reluctance from the big guys can actually create opportunities for individual investors, right?
Yeah, if you're willing to do the homework on those less covered stocks,
Yeah.
you don't have that same institutional pressure.
Right. The author's experience during the '87 crash is also really telling. He was actually in Ireland at the time.
Oh, wow. Must have been stressful.
Yeah. But despite the panic, the crazy headlines, he recognized that the underlying economy, the fundamentals, were still pretty solid.
And the market did eventually recover, didn't it?
It did. Now, contrasting that with the 1990 market decline, that one was different. It happened alongside a recession, banking problems, the Gulf War.
So, more fundamental worries behind that drop.
Seems like it. Even though '87 was maybe sharper, scarier in the moment, '90 had more underlying economic issues tied to it.
Yet the market still came back after that period too, right? The book emphasizes that.
Exactly. Even after that uncertainty, the market went on to have significant growth later.
Which leads to a really important point about, the constant doom and gloom predictions, the endless warnings about the next big crash.
Oh, yeah. The book even jokes about the Great Depression of 1990 that never happened.
Right, and the whole Y2K scare, all these widely predicted disasters that just didn't materialize.
It's a good reminder to take those kinds of big pronouncements with a healthy grain of salt.
A very large grain of salt, maybe.
And the author offers a very practical piece of advice here, something I think every investor needs to hear. Never invest money you'll need in the next, say, 12 months.
Ah, the short-term cash needs.
Yeah. Because, as we've seen, the market's short-term moves, especially during bear markets, can be totally unpredictable.
You don't want to be forced to sell at a bad time just because you need the cash for rent or something.
Exactly. Okay, let's tackle that big question that looms for a lot of people. Is this whole stock investing thing just, gambling?
It's a really common perception, isn't it? And the book addresses it directly. It acknowledges why people might see it that way.
Right.
But it immediately draws a contrast between long-term stock investing and other things like bonds or even real estate.
The data it uses is pretty striking. Looking back from 1927 to 1987.
A long stretch.
Yeah, 60 years. Stocks delivered significantly higher returns than both corporate bonds and treasury bonds over that period.
And the reason given.
It boils down to company growth, right? When you own stock, you own a piece of a business that has the potential to grow, innovate, become more profitable. Bonds, well, your return is usually just that fixed interest payment.
Makes sense. But the book is also nuanced here, isn't it? It says the line between investing and gambling isn't always crystal clear.
Right. It kind of depends on the market conditions at the time.
Like the late 1920s example.
Exactly. During that super inflated, speculative market, buying stocks on margin, well, you could argue that was definitely closer to gambling than sound investing.
So context matters.
Hugely.
Yeah.
The discussion about houses as investments is interesting, too. There are advantages, sure, tax benefits, maybe it feels less volatile day to day,
Hmm.
but the author totally shoots down that old saying, never invest in anything that eats or needs repairs. Says it's just plain false for houses, they definitely need repairs.
Huh. True enough. And it highlights a really critical psychological trap in investing, doesn't it?
Which one?
That we humans, we tend to be most scared to buy when prices are low.
Which are often the best opportunities.
Exactly. And we tend to feel least afraid, most confident when the market is high and maybe already overvalued. Our emotions can just wreck our decisions if we're not careful.
The sheer volatility of individual stocks.
Mm.
The book mentions an average price swing of, what, 50% per year?
Wow, 50%. That's a lot.
Yeah. It really underlines the danger of getting swept up in that short-term noise, making impulsive buys or sells based purely on fear or greed.
And it makes a fascinating observation. The next big market event, whatever it is almost never exactly like the last one.
Right. But we still prepare for the last one, don't we?
We do. It's like fighting the last war, not the current one.
And the author offers a crucial warning here. Don't rely only on predicting the overall market direction when you're picking individual stocks.
Ah, the LTV Nucor example.
Perfect one. Even if you correctly figured out that the steel industry was going to do well, if you pick the wrong company, LTV in this case.
You could still lose big time while a competitor like Nucor soared.
Exactly. So broad market trends are just like one piece.
Yeah.
You really have to focus on the specific companies.
Got it.
All right, let's shift to something really practical. How do we actually find these potential winners?
Yeah.
And the book's answer is kind of refreshingly simple. Just look around you.
Yeah, this takes us right back to that dumb money advantage we started with. The book really hammers home this idea that you can find those potential 10-baggers, the stocks that go up tenfold.
10 times your money.
Yeah. Just by staying half alert, observing things in your daily life, or maybe within your own industry. You don't necessarily need fancy Wall Street tools.
The example of ADP, automatic data processing, is great.
Payroll company.
Right. Anyone working at one of their thousands, maybe hundreds of thousands of client companies would have seen their success firsthand.
Including brokerage houses, apparently.
Yeah. It was a potential winner hiding in plain sight, based on a service millions encountered.
And then there's that intriguing concept, finding a 10-bagger in ulcers.
Sounds painful.
Huh. Well, the idea is that even negative experiences can spark investment ideas. The example was SmithKline and their drug Tagant.
Ah, the ulcer drug.
Yeah. People who actually suffered from ulcers or knew someone who did had a direct personal understanding of the need and the potential success of that drug.
It's kind of funny how that grass is always greener thing plays out in investing too, isn't it?
Oh, so?
The book mentions, like, doctors investing in oil stocks, oil executives investing in drug companies.
When they probably know their own field way better.
Exactly.
Yeah.
It just highlights the edge you have investing in industries you actually understand through your work or hobbies.
The author even admits missing out on some big financial service companies like Dreyfus and Franklin.
Really? Even him?
Yeah. He saw they were doing well, saw their earnings climb, but his focus was elsewhere, so he didn't invest. A humbling reminder, right? Even pros can overlook the obvious in their own backyard.
Wow. Now, the book also gives us a useful way to categorize stocks, which can help manage expectations, maybe.
Definitely. It distinguishes between, say, slow-growing but reliable stalwarts.
Like Procter & Gamble, Coca-Cola.
Yeah.
Big, steady names.
Exactly. And then potential turnarounds. Companies that were in deep trouble but might be recovering.
Like Chrysler or Ford back when they were struggling. Or maybe Bethlehem Steel, Burlington Northern during tough times in their industries.
Right. Companies coming back from the brink. And then you have the cyclicals.
Steel, aluminum, cars, airlines, industries that go up and down with the economy.
Precisely. And with those, timing is absolutely everything. You really need to understand the industry's cycles to succeed there.
So knowing when business is likely to pick up or slow down in those sectors is key.
Absolutely critical. So just paying attention to your own industry, whatever it is, can give you a big leg up in spotting these different kinds of opportunities.
Okay, let's dig a bit deeper then. What specific characteristics does the book say make a stock particularly attractive?
Okay, the first one might sound a bit odd. Boring companies.
Boring. Why boring?
The author argues that businesses in, well, unexciting industries can actually be great investments. For one, they're often much simpler to understand.
Okay, easier to grasp.
And they tend to attract less intense competition. He uses that example. Pantyhose versus communications satellites. Which one's easier to figure out?
Point taken. Pantyhose, probably.
Exactly. If a business is so straightforward that, quote, any idiot could run it, that's often a good sign.
Right?
Because sooner or later, an idiot might be running it, and a simple, robust business is more likely to survive that.
Huh. Okay, fair enough. What's next?
Then we have the wonderfully named category, something disagreeable.
Disagreeable, like what?
The idea is companies and businesses others find, well, unappealing, maybe even a bit gross. Think waste management, or the example given, safety clean, cleaning greasy auto parts.
Not glamorous.
Definitely not, but often necessary services that businesses consistently pay for. And the lack of appeal can actually be an advantage.
Now,
Fewer people want to start companies in those areas, right? So less competition, potentially more stable profits. You don't see a flood of startups trying to get into hazardous waste disposal.
makes sense. What else?
Another one to look for. It's a spin-off.
The company spun off from a bigger one.
Exactly. The book highlights the potential here. The Baby Bells from the AT&T breakup are a classic example. They often outperformed the parent company and the market.
Why do spin-offs often do well?
Well, the new independent company can really focus on its core business. It might attract investors specifically interested in that niche. Plus, the management team is often more directly incentivized to boost performance.
Okay, spin-offs.
Yeah.
Got it. Anything else counterintuitive?
How about this one? No growth industry.
Investing in industries that aren't growing. That seems backward.
It does, but the argument is that industries like, say, plastic cutlery manufacturing or funeral services, they can produce big winners
Why on earth?
because they tend to be less dynamic. Less radical innovation means less disruptive competition, unlike hot, high-growth sectors where everyone's scrambling.
Like tech or something.
Right. In these slow or no-growth areas, established companies with a strong niche or brand can often just quietly dominate and make steady profits. Think specialized chemicals, maybe, or strong consumer brands like Robitussin or Coke, consistent demand.
Interesting. Okay, one more.
A really strong positive signal, insiders are buyers.
Meaning people working at the company are buying its stock.
Yes, especially executives and directors. When they're putting their own money into the company's stock, it's usually a very good sign.
Why is that so significant?
Well, insiders usually sell more than they buy for lots of reasons, options, diversification. So when you see a pattern of significant insider buying, it strongly suggests they believe the company's future looks bright. They know more than we do, right?
Good point.
The book mentions increased insider buying after the '87 crash as a clear sign of confidence, and the example of Teledyne's chairman consistently buying back stock, even at a premium. That's powerful.
It shows real conviction.
It does. And it's the opposite of companies doing what the book calls diversification.
Diversification.
Yeah.
Love that term.
Yeah, making bad, overpriced acquisitions way outside their expertise instead of sticking to their knitting and maybe buying back their own shares if they're cheap. Gillette's past efforts are used as an example of that less effective path.
Okay, so insiders buying is good, diversification is bad. To tie this all together, the book creates a hypothetical perfect stock, right? Cajun cleansers.
Yeah, Cajun cleansers. It's fictional, but it pulls together a lot of these desirable traits.
Like what?
It's in a boring business removing mildew. It's a recent spin-off. No Wall Street analysts cover it. It's located somewhere out of the way. It has strong fundamentals, and crucially, the insiders are buying shares at a price higher than you can currently buy them.
Wow, checks a lot of boxes.
It's a great illustration of how these positive factors can combine. And the book even uses it to show how even a great stock like this can still drop in a market downturn.
Creating a buying opportunity.
Potentially, yes. For the investor who's done their homework and understands the underlying value. Okay, now let's flip it. What does the book tell us to definitely avoid?
Right, the red flags. First on the list, hot stocks in hot industries.
The siren song of the booming sector?
Exactly. It's so tempting, isn't it? But the caution is strong. The example of Xerox back in the 60s is perfect. They dominated copying initially.
But then competition flooded in.
Right. Hot industries attract tons of players. What looks like a sure thing can get overcrowded fast, and profits get squeezed.
So the initial excitement often fades.
Yeah. Next on the avoid list is that great term again, diversification.
Making bad acquisitions outside your expertise.
And often overpaying for them. The book uses Genesco's history of buying all sorts of unrelated businesses.
And it didn't end well.
Generally, no. It's a cautionary tale about companies losing focus, diluting their strength, and harming shareholder value by chasing shiny objects they don't understand.
Stick to what you know, basically.
Seems to be a theme. And finally, avoid whisper stocks.
Whisper stocks, what are those?
Stocks getting a lot of buzz, exciting stories, maybe rumors, but with no real substance underneath. No actual products, no services, and definitely no earnings.
All sizzle, no steak.
Precisely. Bioresponse is mentioned as an example, lots of hype. Then the stock price collapsed when the promises didn't materialize.
The story can be powerful, but you need the numbers to back it up.
Absolutely. The advice is clear. Wait for a proven track record. Wait for actual earnings. You don't need to catch the very beginning.
You can still make great money on companies that have already proven they can make a profit. Like the book says, if in doubt, tune in later when they have a real business.
Good advice. Okay, let's move into some of the key metrics the book talks about and also the value of, well, actually checking companies out yourself.
Right. One basic metric discussed is the PE ratio, price to earnings.
The PE ratio. How useful is it, really?
It's a starting point. A basic tool to get a feel for whether a stock might be, expensive or cheap compared to its actual earnings per share, how much profit the company makes for each share out there.
So how much am I paying for $1 of their earnings? Is that the idea?
Pretty much. A lower number might signal a bargain, but it's definitely just a starting point. Needs more investigation.
The book suggests a visual trick, right? Compare the price line and the earnings line on a chart.
Yeah, it's a simple but effective idea. If you see the stock price line consistently way above the earnings line over time, it could be a warning sign that the stock's getting overvalued.
But high PEs aren't always bad.
No, not always. Sometimes there are good reasons, like expectations of really high future growth. So it's worth digging into why the PE is high, not just dismissing it.
Okay. Beyond the numbers, the book really pushes the idea of contacting the company's investor relations department.
Yeah, IR. Your direct line, essentially.
To do what exactly? Just chat.
Well, not just chat. It's your chance to get more detail, to test your own investment ideas and assumptions against what the company says.
So how should you approach them?
The key is to go in prepared. Don't ask vague stuff. Have specific research questions ready. Like, what are recent sales trends? What's the current order backlog look like? Any new products coming soon? How's your market share holding up? Are your plants running at full capacity?
So show them you've done your homework.
Exactly. You'll get taken more seriously and get much better, more insightful answers that way.
And for an even deeper dive, the book suggests actually visiting the headquarters, if you can.
Yeah, if it's feasible. It sounds a bit old school, maybe, but the kind of place a company calls home can tell you a surprising amount about its culture and priorities.
How so?
Well, the book contrasts companies with practical, no-frills offices. Pet Boys and Crown Cork and Seal are mentioned, versus companies with super fancy, over-the-top, extravagant headquarters. Frugal offices can be a good sign.
Suggests they're focused on the business, not just appearances.
That's the idea, focused on efficiency and the core business rather than spending excessively on plush carpets and fancy art.
Okay, let's dig into something really crucial now. The company's financial health. Yes, super important. One key indicator the book highlights is the cash position.
How much cash they have on hand.
Right. It emphasizes having a healthy cash balance, using examples like Ford and Boeing, companies that typically keep significant reserves.
And it talks about net cash per share, right?
Yeah, analyzing that can be really insightful. It's the cash left over after you subtract all the long-term debt, then divide by the number of shares.
So cash relative to debt and share count.
But there's a caution, too, isn't there? Just having a lot of cash isn't always the deciding factor for investors.
Right. If it doesn't amount to much on a per-share basis, it might not move the needle much. Schlumberger and Bristol-Myers were examples given at the time.
Okay. And debt. That's another huge factor.
Absolutely critical. And the book makes a really important distinction between different types of debt.
Like a
Bank debt versus funded debt. Bank debt is often riskier because the bank can demand repayment pretty much any time.
ouch. Whereas funded debt.
That's usually longer-term bonds, loans with more structured repayment schedules, less immediate pressure.
The examples of Applied Materials, GCA, and Chrysler really drive this home, don't they?
They do. They show how much impact debt can have, especially when the economy turns down. Companies loaded with short-term bank debt are much more vulnerable to bankruptcy if things go sour and the bank calls the loans.
So you need to look at the structure of the debt, not just the total amount.
Exactly. Especially in turnaround situations like Chrysler, where the specific terms of their government-backed loans gave them vital breathing room.
Makes sense. Okay, let's touch on dividends and book value. Two other things investors often look at.
Right. Dividends first. The book talks about the potential benefits of dividend-paying stocks.
Like providing some downside protection.
Yeah, potentially. Especially those stable, established companies, the stalwarts, that pay out a good chunk of their profits consistently. That regular income can cushion falls a bit.
And companies with a long history of raising dividends are highlighted, right?
Hmm.
Kellogg, Ralston, Purina.
Yes. That consistent growth in the dividend itself is often a really strong sign of underlying financial health and a management focused on shareholder returns.
But there are risks too, relying on dividends from heavily indebted companies or cyclicals.
Definitely. The examples of Southmark and Ford back in '82 show that dividends can be cut, especially if a company is struggling with debt or hits a rough patch in its industry cycle. So the quality and sustainability of the dividend matter.
Okay, what about book value? Assets minus liabilities. Sounds straightforward.
It sounds straightforward, but the author warns against relying too heavily on it as a measure of a company's true worth.
Why? Can't you just look at the balance sheet?
You can, but the number can be misleading. It can significantly overstate the real value.
Like the Penn Central example right before bankruptcy. High book value, but the assets weren't worth it.
Exactly. Or it can significantly understate the true value. Think about natural resource companies like Handy and Harman mentioned in the book.
Outs-
Their assets, like land or mineral reserves, are often carried on the books at their original historical cost, which might be way, way lower than their current market price.
Hidden value.
Potentially, yes. The book also touches briefly on things like goodwill from acquisitions, using Coca-Cola Enterprises as an example, showing how intangible assets not fully captured by traditional book value can still hold real worth.
So book value is useful, but needs context and careful interpretation.
Definitely. It's a starting point, not the finish line. Okay, let's shift now to probably the two biggest questions for any investor. When do you buy? And, maybe even harder, when do you sell?
Crucial questions. For those fast growers, the high potential stocks, what's the advice?
The trick is twofold. One, don't sell too early and miss out on a potential 10-bagger, right? Don't cut your flowers to water the weeds.
Right.
But equally important, you have to stay alert and recognize when that super fast growth phase starts to slow down, because that's often when the high PE ratio can shrink and the stock price can fall, even if the company is still doing okay.
So watch for signs of slowing growth. What about turnarounds? When do you sell those?
The general guideline there is simpler. Sell when the turnaround is basically complete.
Meaning
The company has fixed its major problems and is back to being a more normal, steady grower, or maybe just operating within its usual industry cycle again. The Chrysler recovery is the example used. Once they were back on solid ground, the extraordinary growth phase linked to the turnaround was likely over.
Okay. The book then has that section on the 12 silliest things about stock prices. Right.
Yeah.
Common mistakes.
Yeah, common mental traps people fall into based on price movements.
Like what? Give me an example.
Okay, one is thinking, it's gone down this much already, it can't possibly go much lower. Famous last words, right?
Yeah.
The book uses Kaiser Resources, a stock that just kept falling and falling despite already huge drops. Price alone tells you nothing about how much lower it can go.
What's another silly one?
How about when it gets back up to $6, then I'll sell?
Setting an arbitrary target based on your purchase price or a past high.
Exactly. It often leads to holding on to losers forever, waiting for a price that might never come back. You should sell based on the company's fundamentals or prospects changing, not just wishful thinking about price.
And the impatience one. It's taking too long for anything to happen.
Yeah, that's a killer too. The Merck example is great here. The stock basically went nowhere for a long time, years even, and then suddenly surged. Patience can be crucial with good companies.
Good reminders. The book also touches on options and short selling, doesn't it? Briefly.
Very briefly, mostly just to highlight the risks. Options have that time decay, the clock is always ticking against you, and you need to be right about when the stock moves, not just if.
And short selling. Betting a stock will go down.
Big risks there too. Theoretically, your potential losses are unlimited if the stock keeps going up instead of down. Not for the faint of heart or the inexperienced.
And market timing. Trying to guess the market's ups and downs.
The book is pretty dismissive of that, honestly. It emphasizes how incredibly difficult, maybe impossible, it is to do consistently. Cites examples like the OPEC oil embargo, where the market did the opposite of what everyone expected.
So focus on the companies, not crystal ball gazing about the market.
That seems to be the core message. And on buying and selling, one final point for individual investors, you don't have to follow the big institutions.
There's an advantage to being small and nimble.
Definitely. The author points out that many institutional favorites from mid-1987 got hammered just 10 months later, even though the companies were still fine. Why? Because the institutions simply lost interest and moved on en masse.
So their selling wasn't necessarily about the company's health.
Not always, and high trading volume in a stock doesn't mean it's a better investment for you. The author notes his biggest winners were stocks he held patiently for years, often with not much trading activity.
Interesting. Okay, let's wrap this up. What are some final big picture takeaways from the book?
Well, one recurring theme, maybe a comforting one, is that the country's economic outlook is often perceived as being much worse than the reality on the ground.
We tend to focus on the bad news.
Seems like it. Despite constant worries and negative headlines, lots of companies are still doing well, adapting, innovating, thriving. The author talks about the market climbing a wall of worry and suggests that wall is usually pretty high.
Okay. And the book finishes by summing up some key lessons learned.
Yeah, distillation of years of experience, reminders like different stock categories have different risks and potential rewards. You can't treat a turnaround like a stalwart.
Makes sense.
And while stock prices can definitely get detached from reality short term over the long haul, profits in the market tend to follow the fundamental performance, the earnings growth of the underlying companies.
So fundamentals eventually win out.
Generally, yes.
Yeah.
Also, a crucial warning. A company that's doing poorly can always get worse. Don't assume it's hit bottom. And of course, if you want to go much deeper into all these ideas, we absolutely recommend reading or rereading the book itself, One Up on Wall Street. It's packed with much more detail.
Definitely.
So let's leave you with a final provocative thought to chew on after this deep dive is over.
Okay, let's hear it.
What seemingly mundane, ordinary, maybe even slightly disagreeable business that you encounter regularly? What might hold a surprisingly strong investment opportunity that maybe Wall Street hasn't fully appreciated yet?
Hmm. Finding the hidden gems in plain sight.
Exactly. Remember that dumb money advantage. Your unique perspective, your firsthand observations, they might just lead you to the next big winner.